In chemistry, a reaction only happens when the conditions are right. It's no different in real estate. Welcome to the Alkaline Reaction, a podcast from Alkaline Advisors, where we break down the deals, partners, and capital structures that turn opportunities into outcomes. I'm Spencer Carenti, and today's reaction: how lenders underwrite commercial real estate. Every lender has their own credit box, and every transaction has unique facts. But the framework we're going to use today is consistent across most institutional CRE lending decisions. Here's the core idea. Lenders underwrite three things: the sponsor, the property, and the debt terms. Think of these three categories as you would a triangle. If one side is weak, the other two have to be strong enough to carry the deal. If they're not, the deal doesn't die because of pricing or paperwork. It dies because the risk is not financeable. So let's consider this as the lender would. Imagine a deal hits the lender's inbox on Monday morning. Nice deck, good market, and confident sponsor. But lenders don't underwrite confidence. They underwrite risk. So the lender starts their focus on the sponsor, because the sponsor is the first line of defense should things go wrong. The sponsor underwriting sounds simple, but it's not. It's not, have you done deals? It's, have you done this deal? Same asset type, same strategy, same complexity, same scale. A sponsor who's owned stabilized multifamily is different from a sponsor who's executed a 200-unit renovation program through real construction timelines, real leasing friction, and real budget variance. And lenders price that difference. Then comes financial strength. This is where lenders look at net worth and liquidity, but not as vanity metrics. They're asking one question: when the plan gets messy, how much runway do you have? Because the plan always gets messy. Lease up takes longer. Tenant improvements come in higher. Insurance resets, taxes reassess, rates move. Liquidity isn't a nice to have. It's the shock absorber. And then lenders look at sponsor readiness, the part that rarely shows up in an investor deck but matters a lot in credit. Do you report on time? Do you communicate early? Do you bring problems to the table before they become emergencies? Lenders don't just lend money, they enter a relationship. And relationships fail for one reason more than any other: surprise. Finally, lenders look for alignment, skin in the game. How much equity is the sponsor actually contributing? Is it meaningful? Does the sponsor feel the downside? Because the lender's view is simple. A sponsor with real money at risk is a sponsor who will work harder to protect the collateral. So that's sponsor. Next, the lender shifts to the property, because the property is the collateral, and the collateral is the repayment plan. If the property is stabilized, lenders look for durability. Yes, they care about occupancy, but more importantly, they care about the rent roll. Who are the tenants? When do leases expire? How concentrated is income? What happens if the largest tenant leaves? What happens if market rents flatten? What happens if renewal costs rise? Lenders don't get paid for upside. They get paid for not losing money. So they underwrite the scenario where the rent roll gets stressed. If the property is transitional, the underwriting gets sharper. Now the lender wants to know if the business plan is supported by real evidence, not we believe we can lease it. But here is leasing velocity. Here are market comparables that actually signed. Here is a broker opinion of value. Here is a third-party market study. Here is a financial model created by Alkaline Advisors, showcasing property contributions and distributions. Here is a CapEx budget with bids, because transitional deals don't fail dramatically. They fail gradually. They fail when CapEx runs hot and leasing runs slow. And the lender wants to know, how does this deal survive that scenario? If it's a development deal, the underwriting becomes even more binary. Entitlements, permits, approvals. A lender can't structure around uncertainty that hasn't been resolved. If approvals aren't in place, lenders either step back or demand more protection, more equity, more reserves, more guarantees, more control. Because entitlement risk is not a finance problem. It's a time problem. Once sponsor and property are understood, the lender moves into the part that actually determines approval, the debt terms. Because debt terms are how a lender prices and controls risk. Start with leverage. Higher leverage means less cushion. less cushion means higher probability of impairment if anything goes wrong. So lenders size proceeds based on how much margin for error they think exists. And margin for error is not just the asset. It's sponsor strength, market liquidity, and business plan complexity. That's why the same deal can get 70% leverage from one lender and 55% from another, and both can be rational. Then reserves and cash management. This is where lenders protect themselves against the messy middle: interest reserves, capex reserves, tenant improvement and leasing cost reserves, operating deficit reserves. Sponsors often fight reserves because they reduce proceeds. Lenders require reserves because they prevent default, then guarantees and recourse. In construction and transition loans, completion guarantees are common. Depending on the sponsor and the complexity, lenders may require partial or full recourse, or only carve-outs. This is the lender's way of saying, if the business plan is high risk, support needs to exist somewhere. Then covenants and milestones. This is where the lender adds guardrails. Funding can be tied to progress, leasing thresholds, and performance triggers. Extensions can be earned, not assumed. It's the lender's way of ensuring the deal stays inside a controlled outcome range. And finally, exit metrics. This is where lenders ask the question that quietly decides most credit approvals. Can this refinance in the real world, not in the sponsor model? In the world where rates don't fall, where cap rates widen, where net operating income is slightly below plan, where leasing takes longer than expected. This is why lenders focus on debt service coverage ratio, loan to value, and debt yield. Debt yield is simple: net operating income divided by loan amount. It's one of the lender's favorite metrics because it removes cap rate assumptions and forces the question: how much income is this loan actually sitting on top of? Now here's the part most borrowers learn too late. Lenders don't finance upside, they finance risk. Equity underwrites growth, debt underwrites protection. And that means deals usually break for one of three reasons. First, the sponsor is undercapitalized and the lender doesn't believe they can survive turbulence. Second, the property is too fragile. Lease rollover, capital expenditures, market softness, and the lender doesn't see durability. Or third, the terms are too aggressive, too much leverage, too little reserves, too thin an exit. And the best sponsors understand this. They don't pitch lenders like they're selling upside. They present the deal like it's a credit. They show how it survives. They show how it exits. They show how they perform when things go wrong. Because in the end, the lender decision is simple. It's not, is this a good deal? It's, is this a safe loan? And that's today's reaction. If you found this episode helpful, please subscribe and join us next time as we continue breaking down the commercial real estate industry. I'm Spencer Carenti, and thank you for your time.